We are live. Okay, so welcome everybody online. You are joined by how many people in the room? Online, is it something, do we have a number? 500 online, and we have about 150 in the room, roughly. And so welcome everybody. First of all, welcome to this first opening event. I am joined here today on a panel to discuss institutional and corporate investment. For those online, my name is Felicity Spores, and I work as Head of Sustainable Finance at the Gold Standard Foundation. The Gold Standard is a standard some of you may be familiar with in carbon markets, some of you may be familiar with in Scope 3 emission technical work, and increasingly you will be hearing about our work to help portfolio fund managers better manage and measure and maximize impact. We are a sustainable development impact standard. I'm joined today on this panel by Martin Berg and by David. I've forgotten your surname, terribly rude.
Gardner.
Sorry. So maybe if you'd just like to introduce yourselves before we get started on the conversation.
Yeah, perfect. Yeah. Good morning, everybody. Martin Berg. I'm from Climate Asset Management. For those that don't know us, we are a partnership between HSBC Asset Management and Pollination, which is a specialist investment advisory firm. What's different on us, we're only focusing on investments in nature. So we're building a whole asset management firm around nature, and what that means is we are building products both for institutional investors and also for corporates around agriculture, forestry, but also now carbon emissions and emerging markets into what we call environmental attributes, biodiversity-related revenue streams. So we're trying to really bring this to the mainstream. I think I was, in your notes, introduced as an impact investor. We actually see us not necessarily as a typical impact investor, but much more as a new investment house that tries to bring this much more to the mainstream. My role within that is I'm the Chief Investment Officer of our nature-based carbon strategy, and I look forward to discussing all these issues today.
Brilliant, thank you. And over to you, David.
Thanks very much. My name's David Gardner. I'm the CIO of Gresham House Forestry. Gresham House is a specialist asset manager based in the UK, doing work internationally as well. And the Gresham House is really focused on real assets and those that have a sustainability theme. So we cover new energy, sustainable infrastructure, housing, etc. Of the 6.5 billion assets under management, 3 billion is in forestry. So forestry is a very large component of our business. We really specialize in commercial forestry that provides solid returns with all the underlying themes that forestry gives, and that will probably come out in the conference. But on top of that, of course, we are very much looking at the natural capital markets, carbon, and very involved in all of those businesses. So it's going to be great to have this conversation today and to flesh that out a bit.
Brilliant, thank you so much. I'm very interested, first of all, in understanding, I mean, both of you have indicated that you're quite well vested in this field of investing in forestry and nature-based solutions. There is a difference, of course, nature-based solutions being a bit larger than just forestry, and forestry sometimes inching into nature-based solutions. So there's a grey area between. I'm kind of curious how, in your experience, investments have been changing. So we've seen a lot of regulatory change, a lot of the ESG evolution, the taxonomy, corporate social responsibility, and a lot of talk about greenwashing. How do you see, how would you summarize maybe the key things that have changed in the last 5 years? Martin, do you want to start with that?
Yeah, I think I wouldn't go that far away as 5 years. I think it was actually a very rapid recent change. If you look back at forestry, at agriculture, from an investment perspective, so we have a very, to some extent, even niche investment themes for specialist investors, right? In the forestry side, we had the TIMOs in the US. You had some very well-known large agriculture funds that were probably not necessarily known to everyone in finance, such as like a BlackRock or other asset classes like the big private equity houses. So I think what really has changed is that, and as said, I don't think it's a 5-year trend. It's really more like a 2-year trend. The whole focus on net zero, the whole kind of introduction of new revenue streams for these type of projects, in particular in forestry. I think forestry has changed quite a bit from being really a very much an analysis on what can be done actually with the underlying timber, what are the market trends there, to now having actually different revenue streams building in natural capital, in particular carbon. I think carbon has changed the equation. At the moment, of course, it's not really a regulatory market, it's a voluntary market, but I think you see a lot of excitement. I'm very actually interested to hear what David has to say, because I think they're one of the pioneers in that. But we see that there's a lot more excitement now from an also institutional investor side for these carbon credits. And then I think the other thing we will talk about is that in particular also corporates are now very active in this. And so I think it really turned the whole kind of look at forestry and agriculture on the head, from being something really niche and something that many people would like to invest in. Some already do, but a lot of people are kind of standing there, how do we do that? And natural capital is probably something that kind of adds another layer of opportunity in there that probably at the moment is still something that many investors try to grasp, but that is definitely something now that makes a lot more investors looking at this.
Thanks. David, to you. We build on that.
Thanks very much. So first of all, natural capital is a very wide subject, and forestry is natural capital. So, you can't sort of separate, say, forestry and natural capital, because it is all in one part of it. And I've been in this business for more than 30 years in international forestry, and what I've seen from the investment side is that forestry was very much just a corporate investment or a pure financial investment. In other words, it just looked at the main themes that forestry has as an investment class. It has good risk-adjusted returns, it's very stable, it has inflation protection, it's driven by biological growth, all those good things. And then what's happened really in the last, as you say, less than 5 years, is there's been a really serious, significant interest in forestry as an asset class from the institutions because of its sustainability and carbon angle. And so, of course, if you manage plantations well, they are 100% sustainable. You fell them, you plant them, and life continues. And all the time, they're sequestrating carbon. And so this is where the interest is, both in the sort of path to net zero, but also down to a corporate level as well when we get into carbon offset credits. So there's sort of different levels playing here.
You've interesting comments there. I'm just going to pick up on two things, which were not in our notes. But you mentioned that plantations, if managed well, can contribute to sustainable development. And Martin, you mentioned that there's growing interest in the carbon value. How well do both of you think that carbon value is driving genuine sustainable development outcomes, including contributions to climate change? And is there any danger with the fascination with carbon? Who wants to take that first?
I'm happy to take it first.
Yeah.
I think David put it very nicely. I think this drive for sustainability has really led to more investors are looking now at forestry in particular, but agriculture to some extent as well, and as a kind of a new asset class for many of them, because we have to think about it. I still think that forestry was a bit more of a specialist investment class. So now what we are seeing is we're seeing very large institutional investors, insurance companies saying we have to reshift our portfolios. We looked at some of the climate risks. We're looking for new asset classes, and some say I'm looking at natural capital, others saying I'm looking at forestry, others are looking at agriculture. Some try to kind of find a real home, actually, and that's one of the issues at the moment still. Where does this actually sit, in particular when you look at through the natural capital lens? And that has really changed I think, quite significantly the appetite for investments in this space. There's obviously then also, it's always the same time. The moment there's an opportunity, there's a multitude of players that are emerging, and it's very difficult to decipher who can actually really deliver what they're saying. So I'm sure lots of you who are in the investment space will receive a lot of investment opportunities. Sometimes it's very difficult to say, is this real, is this not real, in particular when it comes to faraway places. And I think that obviously opens up now also some risk with that is clear. I think also when we talk about carbon, how you measure carbon and how you then also verify it later on, what standards are using. I mean, you are the expert with coming from the gold standard. That's obviously another aspect for them. But so I think in a way it's good, because I think we need to look at forestry in a more holistic way. As David said, there's a lot of, it's not only the carbon, but it's also the biodiversity or the other natural capital that is embedded in forestry. And we could do so much more if we could assign a value to it. But at the same time, by doing that, we're also posing some risk in there. In particular, if we go beyond, well, even with carbon, I think there are lots of projects out there that are not real, that don't have a proper baseline, that don't have a proper methodology, that are not using an accredited standard and so on. They're not using verifications. And then, of course, that is not credible, and that lends itself for some greenwashing. But I think I'm always historically coming from the carbon side. I very much believe it's actually what we need to do is to build a credible market, not only for carbon emissions, but also for other positive externalities that nature provides, biodiversity and others, in order to really bring this to the next level for the investment community.
Yeah,
Please
going
build
back
on
to
that.
your question,
Yeah.
really, it's this sort of all this carbon hype sort of derailing things. And I think there is an element of that, because if you look at forestry is part of the global net zero solution. And I say a part of it, of course. But a lot of organizations are just looking at their own net zero targets, and they're saying, where's the offset credits? I need offset credits. And instead of sort of saying, well, actually, we want to invest in this asset class because it's doing, it's meeting the global net zero targets. They're focused in on the net. And of course, commercial forestry, it's very difficult to produce carbon offset credits. And so people get derailed away from the better and bigger thing to focusing on their own sort of small issue, and I say, well, if you want to do that, go and find some voluntary credits and go and, you can do better just to go to a broker than to invest in this asset class and all that involves. So yeah, there's different ways of looking at it, and I think the hype on carbon credits sometimes overrides the bigger theme that we should all be focusing on.
Welcome, Gaetan. Would you like to introduce yourself? And if you had the same problem as I did getting here on the Jubilee line, we understand. Would you like to just introduce yourself, where you come from?
Sure.
And then the question I'd like you to respond to straight away is, we've talked about the change in the market, and we've talked about the kind of raising of awareness about carbon value, the importance of forestry and natural capital, the increased professionalization of carbon markets, bringing in new kinds of finance, so new players in it. At the same time, new players, some credible, some not, and a kind of sense of how do we get credible pipeline was a kind of unspoken question. Just throwing that at you, while I give you a bit more time to think. So welcome, and if you'd like to introduce yourself, welcome to the panel.
Yeah. Hi, I'm the guy late. I'm Gaetan. I'm working at BIO, the Belgium DFI, so we focus on emerging market only investment. Also, we are part of the EDFI, the European Association of Development Finance Institutions. Well, I'm in charge of SME, corporate investment, direct investment, which includes agro and forestry as a major component. When it comes to straight answer your question, I think as an industry we need to be careful that one thematic taking a lot of voice, and which is very important at the moment, is not overshadowing the rest of the issue that we need to face, a bit like what you were mentioning, like biodiversity, local community, economic empowerment, where we're active. And so that's the balance we need to find, and making sure that basically that huge amount of potential new asset class and new money coming in is not basically having a too narrow view on what a challenge we need to address to face the long-term trend of the world.
Thanks. The UN notes that there's a 5 to 7, it's not exactly precise, trillion investment gap. For anyone in finance, a gap means supply and demand mismatched, an opportunity. But we already heard from Martin that the opportunity is there's risks. There's risks that the project developers aren't credible. There's risks because it's new financial streams, such as carbon credits that we haven't used before. The tools that we have aren't quite optimized for these new types of assets. However, what do you think in the future could help investors, or what are you working on to help investors and maybe the community in the room and online actually identify the opportunities, create these credible markets, and make sure that we actually do get this shift of finance from where it's going now, which is a little bit round in circles. If you look at the Climate Policy Institute's research on climate finance flows, it flows in circles in Europe and safe havens, and really gets to where you can maximize impacts, which is in emerging markets primarily. What do you think, what are you hoping to see, let's say, in the next rapid changing environment of, you said 2 to 3 years, Martin, so what are you placing your bets on to see this shift?
Yeah, so I mean, how we communicate this better? Well, firstly, I think that more clarity for investors is really needed on both ends. What, for example, does it mean to invest in natural capital from a pure investment perspective, but then also what is a credible carbon offset project, and how can we take this to the next level and maybe have some mechanisms also for biodiversity that are not prone to greenwashing. And so the way the approach we've been taking is, especially on the natural capital side, we believe a lot of more information is actually necessary. There are a lot of asset managers at the moment that are offering different products. It's always said natural capital is an asset class. I think in my mind it's an investment theme that can be integrated in almost every single asset class. And so what we formed with, I think I just saw Gauthier Curie from Mirova walking in with Mirova and with Lombard Odier. What we've done together with the SMI under the auspices of His Royal Highness the Prince of Wales is to form an organization which is called the Natural Capital Investment Alliance. And the goal is to bring in asset managers that identify, go in front of investors and really explain what does it mean to invest in natural capital and what options are there. Because what we hear a lot is that, right, I would love to invest in natural capital, but there are no products. And the reality is there are products, and they're not all real asset products. They are not always meaning that you have to invest directly into a forest or into an agriculture project. There are a lot of liquid, illiquid, fixed income, equity-like products out there. And so the goal of this alliance is to really showcase this and to make the case for natural capital as an investment theme. And that's the one thing we're doing. We had a big announcement at COP where we enlarged this to 15 members. And we're actually now working through, or we're just developing the work program. And we are also, in case any other asset managers here, we're very much open for additional members, because we think it's important that also the asset managers kind of clearly articulate what is actually on offer and to helping the investors. And that goes back to the point that many investors are interested, but they're struggling and saying, where do I actually put this? Where does it fit in my asset allocation? Is this property? Is this equity? Is this something else? Do I have to get through a completely new approval? And I think we want to help them with that. So that's on the investment side, and then in particular on the carbon side, we think we really welcome the VCMI and the ICBCM, the two organizations that are now trying to get a bit more credibility in the market. In particular, we're looking forward for the VCMI's guidance for corporates. What is actually what should they do in order to achieve the net zero target? And we very much, we have our own view what a good credible carbon credit is. And we publish this on our website. So we think that is a part where we really try to engage to also demonstrate what is the highest standard and where can you avoid greenwashing.
Thank you. Gaetan, would you want to respond to that question, the same one? Like, what are you hoping to see in the next 3 years, rapidly evolving, that will help us shift money that will fill this gap? We know we've got the money in the world. It's just that it's not getting to where it needs to go to deliver on impact.
Yeah, what I can tell you is at the ETFI Association, the European Association, there is some also willingness to put in place with probably some of you are already aware, there is the EFSD plus guarantee scheme from the European Union. And at the association level, we try to put in place a guarantee scheme that could really help to pioneer and flow money into more even the frontier aspect of natural capital and not yet the plain vanilla, which is already sometimes a challenge for some investor investing, but really to prepare the market for the next part. Next to that, I totally agree with what he said, so I don't have anything to answer except I totally support the alliance.
Brilliant. David?
I think, in your great opening sort of session there, risk came up as one of the barriers to investment. And so those sort of ideas on sort of guarantees is one way of doing it. I think maybe for the larger institutional players, what they're looking for is how to mitigate the risk in these new markets. And so our strategy is really to say what we think is the right way is to underpin your investment in a solid asset class, in our case forestry, and then take the upside on these new markets as they emerge, because they are full of risk. They are full of policy risk. And prices can halve overnight with one stroke of a pen. And so what we're saying is balance it out and balance that risk, and have your primary investment in something which is solid, stable, well-known, and it has to be integrated. And so we see forestry, we see biodiversity credits, we see carbon. All of that can be integrated into the forestry component, and you have a sort of risk-adjusted return, but with the upside of these high-moving prices.
Thank you. Now I'd like to open it up to people in the room. Having heard those two questions about how the market has evolved, we see discussions around different investment models, utilising the value of carbon. We've had a recommendation from David about focusing on something with a clear economic revenue where you know what you're doing, and then utilising the additional asset value. We've had driving it forward through political engagement, and we've had Gaetan talking about the need for liquidity and guarantees to address the risks associated in going these markets. Could I give the floor to you? Do we have any microphones? Or?
Yes.
Yes. Could we give
I have a question from the panel at home, the audience at home, actually. So
I've just given the lady in the front the opportunity to speak. If we could.
whilst we do that, I'll give you this laptop.
You give me that laptop.
Seamlessly.
Seamlessly. Here we go. Thank you.
Hi. So I mentioned this up front. I was really pleased to hear some of the topics that you were addressing there, but one of the key barriers that we see is with investment consultants. So, and this focus on modern portfolio theory, the risk-return efficient frontier. And until we start to build in and start looking at investment as 3D investment, where you build in impact, we just aren't going to move that further forward. So how are you sort of addressing this from your perspective? Obviously, in some cases, being a broker between the asset owner and the underlying corporate. And how are you trying to help shift that dynamic? Because that's really what I see as the strategic need in order to really push capital forwards.
I think we work with quite a lot of the consultants, and actually I think it's an educational process to a large extent. We find institutional investors in general are quite far down the line with forestry and natural capital. It's not been a main theme. And so again, with the consultants, often investors are asking consultants to say, is this the right thing we should be doing? And actually, to be quite frank, sometimes you're teaching them a lot about the asset class and about these new markets. And so I think it's just a learning curve. I think it needs a lot of education into it.
I would agree with that. We face the same issue. The moment you try to introduce something new, even if it's a nuance, then especially investment consultants, because they have obviously some fiduciary obligations as well, they take a little bit longer. I think the upshot is, and that's why we're investing a lot of time speaking to them, is that once you convince them that this is a real new, whether it's an asset class or investment theme, or they find their niche, then you can really mobilize a lot of new investment in this space. And I think the consultants, at least in our view, they are particularly asking, okay, where does this sit now in a proper asset class allocation? And I think it's probably clearer in forestry, what Gresham House is doing, where it is established real asset class. But when you look at some other strategies that either combine forestry and agriculture, what we're trying to do, for example, that bringing in new revenue streams from maybe even over the long term, then it is a bit more challenging. It just takes some time. I can only underline, and I think it's our approach in particular with one strategy focused on institutional investors where we do the same, is you need to embed it into known asset classes. So we're focusing very much on a combination of agriculture and forestry, and then saying the carbon or the biodiversity or some of the other new revenue streams, they're really add-ons. They're basically upside for you, but you still have a very stable and low risk in an inflation correlated asset class that has all the other attributes that and I think those are the messages I need to hear, but it takes time. I think I would fully agree.
And maybe one last point is on the impact side, the third dimension that you were mentioning. The easiest way is to look at it as a de-risking tool. Is basically the more impact you have, the more you secure the local community license to operate and so on. So I wouldn't try to because then you need to change the whole industry about fiduciary duty. It's actually, do they have impact in their fiduciary duty, which is not, always that obvious. So I would try to make risk and the return potential linked to the impact as the biggest link, because as you mentioned, the new revenue stream linked to your impact and the externality you're creating is basically potential revenue. That's on that side, and on the de-risking side, the impact is a key driver for all those projects.
I think it's a really good point, but what
you.
our experience has been that the risk reduction element of the impact is less convincing than to saying the impacts actually offer you an additional revenue stream. That it seems to be more, in particular with consultants who are then also very much looking, you get in the old discussion, what's our fiduciary duty to prepare impact, to present impact or to support revenues. And I think that's at least our, but we fully agree. We started off always saying this is a significant risk reduction by focusing on the impact, but it was less convincing.
Interesting, because we have a comment from online asking something very similar to that line, which is Edward Styles or Stillis, I don't know, sorry if I've got your name wrong. As a forestry carbon project developer in Africa, I'm more comfortable developing commercial forestry projects in preference to pure conservation, i.e. the impact of conservation isn't making him feel comfortable due to the timber revenue hedging, the volatility in the carbon market, exactly what you said, David, and providing greater long-term incentives to manage the forest. So it's not utilizing the value of impact. Do you think that could be something that could be changed? Is it possible that as what I keep saying at the moment is we're in a world of a million funds bloom, and we can have only so many. What happens if the water fund competes with the Jaguar corridor for biodiversity, competes with the renewable energy fund? We are not that far, so they welcome all funds in the first instance, but tomorrow, is there going to be some preference for impact? When will regulations recognize that? When, as investors investing in assets that have a lifetime of 30 years, are we going to start thinking about it? Is that something that you are considering? And please put your hand up if you have questions in the audience here. Please, okay, then I'll stop. Please, this gentleman, and then this gentleman. And lady next, please. Oh, sorry, I'm a lady here, please. Start over here, and then you can walk around, it's maybe easier.
Hi, Ed Asaley. Quick question regarding exactly this theme, where this distinction between commercial timber and essentially biodiverse mixed native forests. Clearly one has a much more biodiversity habitat impact and has no essential commercial revenue. The other one is essentially, as we've heard, a long-term sustainable business. Is there room for carbon credits in the commercial timber market? Does it pass the additionality test? It's a controversial subject. I'd just be interested in your view.
Let's collect 3 questions, and then
Hi, Felicity. My question is from an institutional investor perspective, right? We just heard that you could best combine carbon streams with forestry streams, commercial forestry streams, but institutional investors can do that very well themselves, right? They don't need to do one fund manager to do that. And the point is sort of that we don't have enough projects, carbon projects, biodiversity projects, etc. So if we only would stick with the forestry ones, we would have even less. I agree that it's a good risk diversifier on the asset scale, but yeah, I mean, you haven't touched upon the paucity of projects around, right? And that is a very big thing, risk, I would say.
Okay, can we take to this lady here, and then and there's a gentleman over the back. We'll answer the first 3 to the gentleman in the back because you're a long way away, so she'll have time to walk to you, and then we'll take that question.
Hi, I'm hoping you could expand a little bit more on some of the guarantee schemes, because I'm quite fascinated in the space generally. My background is in investing in emerging markets on pension funds. And there's a reluctance due to the perceived risk of the assets anyway. So if you look at the allocation in pension funds to emerging markets, they're already very low. Yet, if we look at the investment gap we've just spoken about, that money has to flow to emerging markets. So what is the key? Is it policy or is it education? Because if you look at policy and education, both of these might take considerable time, which we don't have if the UK in particular is going to attempt to meet its net zero objectives or goals.
Thanks. So just a quick summary. We had a question on
Commitments, actually.
Yeah.
Commitments,
Commitments,
not goals.
yeah. So we had a question around additionality and can we use carbon? Can we, institution investors can combine projects themselves. There's not enough projects for them. They have to go beyond good forestry with good income revenues. And what about guarantee schemes? Who would like to go first? And feel free to answer all three or one or.
Maybe I'll start on the first question because it's a very good one and it's very complicated actually. Does commercial forestry and carbon credits go together? And of course, if you look at the carbon schemes, they all have an additionality clause, which basically means, if it's business as usual, no carbon credits. So every commercial forestry that's doing a good return is excluded from the carbon markets. I do understand it, and I understand the rationale behind it. Personally, I think as we go into the future and the climate crisis becomes more of a crisis than it already is, and people really start to think about it, I think actually some of that will fall away. But that's not now. And so today, most commercial forestry is outside of the carbon credit market. What is changing is carbon credits are coming into schemes on new planting. So they're saying, okay, if it's existing, that's fine, then no credits. But if you're going to take new land and afforest, then we are willing to give you credits. And so if you look at the Australian market, if you look at the New Zealand carbon markets, etc., they're allowing new planting to achieve carbon credits without the additionality rule. And so it's sort of starting to come, but in new planting. And I think there is a space for it, although today it's not really there. And also the carbon markets don't take any recognition of the fact that if your tree gets cut down and it gets locked up in a wood product, maybe for 100 years, none of that storage of the carbon is actually accounted for. So I think that's also very negative towards commercial forestry. It's coming round because governments are realizing that the construction industry is very carbon intensive and has a lot of carbon emissions. And so taxes are coming onto construction, which feeds back to commercial forest owners. So it's sort of coming back in a roundabout route, but it's not in the scheme at the moment.
Martin, do you want to take another one?
On this and also on the question you had before online, I think it's not, as you say, it's not an either or, right? I think there are, generally speaking, of course, David is absolutely right. It's very difficult if you run a forest on the standard way to get carbon credits. But there are a lot of opportunities to do adjacent projects, to look at projects differently. I think when land is sold today, forest land, and there's an opportunity for afforestation, then I would argue probably you look at it completely different now than you had 10 years ago, where you would say, okay, what's my option here? I can either now grow this, takes 15, 20 years depending on the species, and then I have my wood products, or can I make at least out of a portion of that a carbon project? And can I hedge this now, or can I take a view on the carbon prices? I think it has changed the dynamics. The way we look at it, we're looking now in North America at some projects, but this is exactly the discussion when we go to the investment committee. Those are the type of discussions you will have now as investors, and I think that changed the equation. I think the New Zealand example is really a good one. Yep. If you look at New Zealand, the carbon is priced in through the land value, right? So in the UK, I would argue as well, right? I mean, you're the expert there on the woodland carbon. So it has changed the dynamic, and that's not necessarily a bad thing, and it provides more optionality, and I would think that's actually what interests investors now. And don't forget, a lot of even institutional investors come at least to us and saying, could you also deliver me that carbon in kind, because I have my own net zero target, or I want to build a carbon neutral product, or I have other obligations why I would like to actually have that carbon, at least have the optionality to either sell this or to get it in kind delivered so I can have a use case. And again, that changes the dynamics significantly. So a lot of, I think anyone who's now an asset manager in forestry will see that equation will come in, and I think we'll speak probably about the corporates later on, and they're obviously even more interested in the carbon side. Do we have enough projects, good projects? On Joss's question, of course not, Joss. It's always the same thing. But I would argue you have to go through a good fund manager, and then they can help you to source this. And I'm sure David would agree, right?
With a good
We
standard.
share that.
With a good standard to help you find the right project. Yeah.
Yeah, but maybe on the guarantees, it's probably I can leave this video. But maybe one thing, because on my prior life, I worked at the European Investment Bank, and we always had the guarantee schemes, first loss funding, and I think. You asked the question, right? The elephant in the room is what is better? Is it better to have good financial tools to bring an investor, or is it good policy? And I think from where I'm standing, it's still, if we had better regulation, if we had an ability to long-time price and even carbon now, then I think we would be in a completely different investment world than we are now at the moment. Absolutely. So all these guarantee schemes and first loss funding, they are a way to get investors in, but they can't substitute for good regulation.
Yeah, so, I agree. On long term, is the market needs to solve this, and in the meantime, preparing some market with like this kind of tool can be a way forward, because even for you, some projects are too risky, they are too frontier, and so to prepare that for longer term, it might be a source. So it's a combination of all these, and we as DFI, we have our role is to try to pioneer where, let's say, the commercial, more traditional institutional investor through funds or directly can already now be active, and we need to prepare the next stage. That's part of our role. And then on lack of project, that's a bit what I was referring to, is we are not yet there where there is too much money and basically you cannot make any more return or appropriate return with the asset class or the team. But clearly that's something that needs to be worked on, and in balance with, like, we need the land for food security, we need the land for many things. So how to combine our carbon targets or natural capital and basically food and other goods. So that's going to be an interesting challenge.
Gardner, could you also talk to the guarantees question, since you mentioned that in your opening, about the work that you're doing around, there was a question about urgency. Are we going to get there in time? We've got to do this faster. Nice stories if we can only use timber revenue, but we need to do more and get into low developing countries or emerging economies. What's shifting the dial? So, you talked about guarantees, and that's clearly one approach to address sort of liquidity, I guess, is the other one. So you're talking about guarantees, but maybe, and then afterwards we'd like to take this gentleman's question in the back.
I think on the guarantee, basically it's also, first just to have it in place takes time. And then when you have it, to actually having access to it for every project, sometimes it's also adding time. So I think we need a combination of all the force, market, regulation, guarantee, everything. I've not much to add.
So the gentleman at the back, if you could stand up so you get your mic, and then the lady here. That's great, thanks.
Is that it?
Yeah.
Hi, my name is Charlie Setchell. I'm a founder in a new business called Forestry Linked Securities. We're a platform matching sustainable projects with institutional investors. In my experience, one of the biggest challenges has been the topic around liquidity and duration. And I'd like to put that question to the panel. How do you respond to institutional investors when you meet that problem?
Could we take, there was someone over here, yes? And then we had some people here at the front, some ladies here at the front, so.
Thank you. Hi, my name is Ezgi Kiris. I'm with British International Investments, also from the DFI space. There was a bit of talk around kind of local community, sustainable development, social license to operate, and I'm quite curious to know also, as an ESG practitioner, when we move outside of the DFI space, how do you see the trend in incorporating kind of the development impact goals, or kind of these balancing almost like different use for the land, or relation with the communities and everything? How do you see the trend going outside of the DFI space? Thank you.
Do you want to take those two questions, and then the ladies can come after us? There's over here, because there's a long walk. Do you want to just take those two questions first?
We have a mic.
Oh, you have a mic. Okay, please, then go ahead if you have the mic.
I'll give you mine.
Hello.
Yeah, it's working.
No, I've never really needed a mic. Thank you. So my name is Jana Guevorcan. I come from an organization that's really quite on the upstream of what you guys do, Group on Earth Observations. So we really convene sort of science, public, parts of the private sector to generate evidence to inform your decisions and investments and public policy. So can I cheat and ask kind of two questions? But you can choose whichever one you want to ask. So you talked about de-risking a little bit, and I love the question about how can you integrate sort of the impact side in order to kind of move in the direction of de-risking. I'd like to come at it from the upstream side. In terms of the de-risking with having better information or access to better information, what have you observed in terms of, what would give you that evidence for better predictability so you can kind of close that gap? Because, like I said, we use remote sensing and other observing systems to kind of create that knowledge using the best of science of 114 governments, et cetera. So that's one question. And then the other one, because you talked about sort of commercial projects that can generate revenue, which obviously, drives the motivation. But if we're talking about really, conserving and meeting the sustainability goals on the biodiversity side, we deal a lot with indigenous peoples and local communities. And I think the numbers we use are, there are 5% of the world population who manage 80% of the biodiversity. And the financial flows, based on what I'm understanding from them, are simply not getting there, not getting to them. They are obviously a very different category than the sort of assets that you manage. But how can we, if we're really to tackle this question of biodiversity loss, I think we have to figure out how to make sure that the finance flows to those communities as well. And I'm wondering if you have any thoughts on that. Thanks.
Okay.
Do I go as well?
You do.
So now my name's Lucky. I'm from a company called Serendip Assets. I'm the founder. I think I'm probably the only project developer in this whole room. I work in Sri Lanka as well as 4 African countries and Cambodia. And let me tell you, it's all very well to listen to all this lovely wall of money, but what you need to understand is that people on the grassroots level in these countries, their capacity to understand the opportunity is not there. So in addition to all these guarantees, what you need first and foremost is to put some technical assistance to people like me so we can go and help the people on the ground to understand that they will get more money from a tree that stays, and it's going to be there long term because of the water and the air, the oxygen that tree provides, as opposed to a dead tree. So can I urge you all, with this huge wall of money, to think about the fact that you need to allocate, first and foremost, technical assistance before you do everything else.
Thank you. I see lots of people, not a wall, but maybe I've got different glasses on. Over to the panel.
Well, maybe I'll start with the first one, since we are sort of in commercial forestry and the liquidity issue. It's definitely there. Forestry is a long-term asset class. When we look at do a financial model, we're not looking at just one rotation of, say, 30 years. We're looking for the next rotation, and looking out over 100 years when we do a financial model. It's very different from most asset classes. And so when you look around at the funds available, they are all long-term, usually with a sort of minimum of 10 years lock-in period. And it's just not an asset class for everybody. It is focused very much around pension funds, endowments, where it ties in with their cash flows going forward when they need the cash. So they are also long-term investors. And so while in the UK, some of our funds, actually, we have a very strong secondary market, which provides that sort of liquidity. It's not guaranteed. And forestry is one of these things where the secondary market has taken a long time to develop. But it is growing, and so informal liquidity is coming into the schemes. But it is a hard one to guarantee because of the lumpiness of the cash flows of the asset class. There's a whole lot of reasons. It's the right asset for the right investor, but it's not for everybody.
Yeah, I would agree on that. We face the same issue. We also try to provide the liquidity through secondaries, but this is not guaranteed. I think actually Felicity and I, we were in a panel just recently in the London Stock Exchange, and I think what was interesting there, the possibility to list funds could solve that maybe, not only for forestry, but also for carbon in particular, because there's of course, that brings in new complications and new risks for some of the fund managers, but that's obviously one way perhaps to do it, to kind of have a listed fund that then provides that liquidity on a long-term asset. But otherwise, I think I would fully agree. You need to find the right investors. We're seeing in particular insurance companies be very interested, and our vehicles have 15-year tenors that we always get either the question, this is way too long, we want to go 5 to 10, or, and probably you see the same, as saying, why do you even bother with an intake? Just keep it open, and we just like to have the exposure for
evergreen fund. Yeah. So
exactly.
you go talk to one investor, they want evergreen. You talk to another one, it's 10 years is too long. It's really, there's a lot of different views out there as to what's right.
Before we go to you, Gaetan, I'd just like to bore down a bit on that very happy response to the questions that were raised around Indigenous people, the need to raise capacity, and the need to integrate across other impact goals. At the same time, remembering Joss's point about lack of capacity. So like the more demands we put on a small market, what are we doing? So there are these two things, right? So what are you, like, yes, that's working for you right now, but given the long-term view and the challenge of climate change and what science is telling us, thank you very much for all your work, about the urgency of this problem, what has to change? Like, we can't just, even what we're doing now isn't enough. Are you looking to scale up what you're doing? Are you taking risks? Or how do you manage those expectations to move out of safe markets and move broader? Or can't you? Is that space for someone else? Just curious. Before we get to you, Gaetan, to comment on, we had lots of questions there.
That question is not for me.
Maybe
yes, please,
coming back to the question, but I think it's interesting because I have a different nuances, at least I noted from the how is ESG being incorporated, and then particular the social aspect, and then in particular Indigenous people. So if you're dealing in developed markets and Indigenous peoples, maybe in Canada, maybe in parts of Australia, but otherwise it's not really as much on let's say on the top of the agenda. But what we see and what we notice is that there's a huge shift. So I'm coming from a DFI, so I'm very known how the ESG thinking goes, in particular also on social. But what I'm very impressed with, in particular from insurance companies, that we get those questions. And I don't see actually a big difference now from a due diligence, from a sophisticated long-term institutional investors on the ESG side than from a DFI. The same questions are being asked, the same type of analysis has been done, the same site visits. You can't do investment any longer if you can't say, even if you're investing in Europe, that you don't have any social issues and how you're managing them. It's huge. It's a really big concern. So I think that's probably changing. I think for me on the more mainstream side. Whereas I think when I look back, when I was at the EIB, we were insisting sometimes fund managers would come. That was not that long ago, 5 years ago. Why are you making such a fuss? Nobody else here is asking these questions. Only you are asking that. And I think that has changed. So I think you can definitely see that this is taken more seriously. When you then go outside EU, and we're doing that, we're financing carbon projects in, for example, globally, but also we're working on a project portfolio in Africa at the moment. We announced this at COP, and then I think I couldn't agree more. I think the challenge at the moment we're facing with these projects, they're actually not, and this is agroforestry project on a very small scale, and it's not as much as an implementation problem, like the classical implementation problem is like where do you get the seedlings from, how do you implement it, but it's really a social project. And you're absolutely right, the real investment now that has to be made is in this capacity building, in having the people buying in. And what's very uncomforting is there's a time lag between when you can achieve this and when you actually have the security that the project goes ahead. And how do you bridge that? It's a significant problem, but I think that's really, I think, where a lot of the DFIs can still play a huge role in helping in overcoming this. But this is something where we are also taking views, okay, yes, this is actually the part that we need to finance before we even investing into implementing the project.
David, would you like to respond and add on before we go to Gaetan and the DFI perspective?
You're asking about behavioural change. Well, it's interesting because we, as we were getting requests for proposals through the consultants mainly, there were so many tick boxes to do. And so what we decided to do is, well, let's just make ourselves a forest charter. Let's do everything that we're going to make commitments on every single investment we make. And so it was interesting, because forestry is blessed in the fact that forest certification is so far advanced that many of these topics are covered off. But then there are gaps. and there are areas which we can do better, in fact. So we're making commitments over and above that. But we wouldn't have done that had not, this is really coming from investor pressure to say, you need to make these commitments. And we're going, well, we've got certification, but when we look at it, it's not enough. So that's one behavioral change. And then just to come back to your question about Cambodia, in my previous life, we were doing institutional investments and we did one in Cambodia. And what was interesting is we saw the aid agencies come and go around we were doing rubber and cashew nuts, actually, on large scale. And we were seeing these aid agencies coming in, and they would have a theme where it would be clean water. And they would come into a village, they would dig the wells, they would do everyone would have water, and then they would move on. And then the next phase would come, it would be toilets, and suddenly, the villages would all have a working toilet. And then they moved on. And, just 2 years later, everything had fallen apart, and the aid agencies had moved away. And the thing that really kept that community going, and the local NGOs that we were involved with, was we were there year after year, pouring money into the communities and into our projects, providing jobs, education. And so aid is good, but often it's too short term. And what you need is these long-term investments that are there year after year, building people, building their lives, building education. We built schools. That's what you need. You need these long-term investments. Short-term, they're excellent, but they have their failings.
It's an interesting point, because I keep observing that finance is in silos. We forget, but you have all your different. You have your TA, your grant, your VC capital, your debt, your project finance, maybe equity, and then you're safe, right? And you have to go through all these double checks, and so there's that problem. So people say we need TA to develop the capacity to enable you to come in and invest. But how do I time that right? Like I'm an NGO on the ground. I don't know where you are. You close your fund, then I have to go to a meeting like this and meet lots of people. It's it's hard, right? Gaetan, I'm just going to hand over to Gaetan, because this is a really DFI issue around, I think, going broader than just focus on carbon, looking at going beyond. How do we get beyond the traditional safe, timber, nature-based issues? We still have to do them, but since there's so much urgency, we have to do that well and more. What are you doing in your organisation to get us there?
Yeah. Well, in terms of first, maybe on the aspect of local community, and you have a difference of cash flow. When are the cash flow arriving? Like forestry takes 30 years. And you need to convince someone to not cutting the tree, to have the cash and feed themselves or heat themselves tomorrow. So there, that's the trick. So sometimes you need to combine that with more shorter-term project or agroecology that might also deliver results the next season, and combine that, or perennial crop, seasonal crop, and forestry. And how do you combine that, making sure there is land for every maturity of your time horizon. So all this is typically what fits into a normal DFI analysis. And I think from a risk point of view and long-term sustainability of your project, you will look at it but from not using the same words, but it's the same thing. And so maybe then on the indigenous people, indeed, you have less that exposure when you develop, when you are working on developed markets. Clearly, when you move into Africa or other region, Latin America, you are much more exposed to that, and there it's all the question about any natural capital, like how do you share the oil revenue. Now we are moving into how do you share the forestry revenue, which is the same thing, and there, well, basically we need to learn from what has been done for other natural capital, and making sure it redistributes the value creation we are creating for shareholder and the world through positive externalities, and there is no silver or gold standards to follow.
Maybe to jump in, what I observed though is so I was active under the Kyoto protocol mechanisms, so the CDM and the GI mechanism. And back then, there were different type of projects. There were more industrial projects. I think that's one point. But there was an attitude to saying this is more compliance-focused markets, and we're trying to actually extract as much value as possible. In other words, to buy these credits as cheaply as possible. And that was very much, I think, acknowledged in the entire industry at that point in time. What I observed now is, and it comes particularly also from the investors in these type of projects, that this is a really serious question. How do you engage the local communities? You were at the World Bank. The World Bank had the problems with actually having very low carbon offtake agreements, and they had to renegotiate them. And a lot of investors are coming to us, I don't want that this is happening to me. So how do you ensure that there is a fair revenue share? And I think that has changed. It doesn't mean that every project is achieving this in a perfect way, but our experience has been, this is a serious concern and you can't get around it. And if you say, no, we just bought the entire stream, and people will say, no, but I'm not comfortable with buying it, because it's actually not only morally not right, but it's also a real business risk for me, because that means I have if prices would go up, then this is not a secure arrangement that you found there. And I think that's a positive in a way. Obviously, you're right. There's no standard for it, and that makes it tricky, and it's a very project by project assessment. But I think that's the option.
There might be some good consultancy business for people specializing in that.
Are there any more questions from the audience?
Actually, one on the question on the impacts.
Okay, yeah, please.
Because it's interesting, because I think it's right. So why don't you? I mean, if I understood the question correctly, was like, why don't you? With all the technology, we are now able to measure the impact, and surely investors must see that.
Yes.
And we make the same argument, by the way, saying, yeah, sure, all of those things, and then we will demonstrate to you what the risk reduction has been, and there is some data that you can show to investors. But the investors are also rightly saying, well, until, it's a bit like the proof is in the pudding. Yes, this sounds really, really good, and I wish this was the case, but until this is actually demonstrated, I think it's very difficult to make the argument. So I think there are lots of activities now to put in new type of technologies to measure. And hopefully over time, this will really demonstrate that there is a risk reduction. But I think at that point, we have something where we can quantitatively go to investors and saying, look, because we put these measures in, and you can see a project with and without, and then you can measure it and you can quantify it. And then I think at that point, you can assign a value to it. But at the moment, it's a bit of a leap of faith for investors who are saying, yes, that's right, we believe you. And I think that's a bit of the crux there. And I think this will be solved by time.
Questions? Yes, please.
Phil Cole, I used to be in agricultural extension years ago, and also in our insurance business, we understand that most of the things we see from communities is less than $1 million. I mean, the problem to aggregate this stuff into something interesting to institutions is massive. So my statement is, do you think that all the cotton production will go into developed countries where you've got an educated
you don't want to start again, do you? An educated land ownership, and completely sideline all the low-income countries where it's just too difficult because you don't have the extension staff, you don't have the expertise. Land title is possibly mixed between private and government. We've already mentioned country risk. It's a nightmare, isn't it? Unless somebody's going to invest in country by country, if you like, forestry carbon extension services, sort of a just-in-time approach to get this. Isn't it a battle we're going to lose?
Pessimist in the room. It's true. Yeah. Any other questions from someone who hasn't? Yes, please, sir. If you could.
Yes, hi, Rob Hayward, founder of GoodFX. We aim to change the fundraising conversation for some of these projects from one-off donations to continuous giving from banking commissions, but that's not why I'm here. I'm here as a sustainability and ESG consultant for family offices, and it was to address this question of modern portfolio theory. And I would challenge perhaps that it's not modern portfolio theory, but a question of fees that is really the main friction in the room there. And I'd be interested, as we know this capital is necessary, it's risky, but it needs to go onto a platform, and advisors need to be incentivized to keep these products on a platform. How do you marry the two of risky emerging market capital going into private projects, but being able to exist on a platform within a fund family and being managed in a professional manner?
Mm-hmm.
Just if you had any thoughts on that. Thanks.
I think yes, please.
I am Pierre Rousseau. What I would like to say is that we need to change sometimes the way that we do financial solution. The existing financial solutions are too narrow. So I don't have a question here, but I just want to give you some ideas. How can we use the carbon differently than the offset, for instance, in order to reallocate the money to the right people, especially the local population? How can we use the carbon as a collateral of funding so we can extend it to other things? There is recently a project working on, you're not the only people working on project sponsor here, where we have, for instance, put together a local DFI with the local banks in order to do a co-advisory of the project, in order to put together the technical assistance and the financing. So that's maybe the way we start to put together. At the same time, at the right level, at the beginning of the project, probably led by entrepreneurs, and then after that you bring together the technical assistance and the different people who want to work it. I didn't say it was easy, but we managed it to do it once, and maybe that's the way we have to think, by bringing more people around and everybody bringing different kind of capital at the same time, at the beginning of the project, in order to lead the project. So we need to really think more in solution than in products. We still finance people still think products, and investors also think products. So by doing that, we can attract several type of investor around the same project. So just for sharing some ideas.
Thank you, Pierre. We have 3 questions and 3 panelists. And we have 1 minute. So 30 seconds, choose your question. David, start first, then Gaeta, and then I'm going to trust Martin to take the last question.
Well, I think the topic of institutional money going to developing countries in these sort of projects is a huge challenge. I've done it in my previous life, and while we found projects that gave very double-digit returns, which is what you want for that risk, they were too small in their investment size. And so by the time you put it into an institutional fund or a part of a fund, all the overheads and all the people you need to sell the credits in these complex markets and things just meant it went into the red. It's very challenging. I'm not sure what the solution is, but I think it's specialists, not the broad funds that will be the solution.
Thank you. Gaeta, you want to choose a question or a response?
That question is not for me because it's a project on platform, and Franck already tried to work on several projects together. It's basically the question is, who is going to fund your very long lead time up to an investment to come back also to your point, and that's the tricky part is thinking about solution means that you need to be very early active, and sometimes with very small projects where you dedicate a lot of resource to it is very difficult, so you need to find a mix between public fund available to fund this inefficiency. Otherwise, I mean, no institutional traditional investor will be able to do it, so I believe. That's my personal opinion.
Martin.
Okay, leaves me for the fee question.
Sorry about that.
No, but it's an issue, right? Fees are always an issue in especially dealing with family offices, and that's probably in particular if they're willing to take some risk. On the other hand, I would say it's the key is like every time, like usually in financial services, you need to create alignment, right? And often those are also very long-term investments, so the key there is to link your fees also to performance in a way. But I have to say, some of these strategies are complex, they're complicated, they require expertise, as you say. So I think there has to be also some willingness on investors to pay the fees. And in the long term, we believe that's probably more valuable than saying I'm taking the cheapest offer. Maybe on your questions, and I agree for the institutional side, going to some of those more difficult markets is really challenging. What we observe now is that a lot of corporates are actually willing to go there in a different way, and maybe that links also to the other question. They actually look at it slightly different. They are looking into their net zero target. They're saying, I want to achieve something in certain countries, perhaps in my supply chain. So they are willing to take different risk, and they look it through a different lens. So, for example, if they want to have the carbon emissions in the end, then they look at this slightly different than an institutional investor who has a fiduciary duty and as a foremost in saying, how do I make a return out of that? And we'll see how this plays out, but I think that is definitely something that we have observed.
Yeah. Okay, I think we are at time. So first of all, if you give me, join me in saying thank you to our panelists, and thank you to all of you. Thank you.